Imagine this: you buy a breakout, and price instantly reverses. You sell a breakdown, and it snaps back. It feels like the market is personally out to get you. In a sense, it is. You're not trading against a faceless crowd, you're trading against institutions with deep pockets, sophisticated tools, and a profound understanding of market psychology. They exploit your fear and greed. But here's the good news: their every move leaves a trace in price and volume. Today, we'll dissect the Wyckoff method, a classic framework that doesn't predict the future but reveals what smart money is doing. By the end, you'll see the market not as a random walk, but as a battlefield where footprints are visible to those who know where to look. The Wyckoff method breaks the market into 4 phases: accumulation, markup, distribution, and markdown. Think of these as the seasons of a market cycle. During accumulation, smart money quietly absorbs the remaining sell orders, preparing for a move up. Once the selling pressure is exhausted, the path of least resistance turns upward. In markup, demand dominates, and prices rise. But the trend doesn't always lead directly to distribution. Sometimes the market re-enters accumulation to build more fuel. Distribution is the mirror image: smart money unloads positions into retail buying, and the path of least resistance turns down. Understanding which phase you're in is like having a map of the battlefield. It tells you where the enemy is likely to strike next. To understand Wyckoff, you must distinguish between active and passive orders. Active orders, or market orders, are the true drivers of price. They demand immediate execution, consuming resting orders. Passive orders, or limit orders, merely provide liquidity. They don't push price but can slow it down. For price to move from 50 to 51, buyers must actively purchase, absorbing all sell orders at 50. If sell orders are plentiful, price stalls. Conversely, for price to fall, sellers must aggressively hit bids. This mechanism explains why price often oscillates in ranges. Smart money uses passive orders on one side to absorb active orders on the other, controlling the price within a desired zone. Recognizing this tug-of-war is key to interpreting market structure. The first Wyckoff law is the law of supply and demand. It's the most reliable economic principle. When demand exceeds supply, price rises. When supply exceeds demand, price falls. But the asymmetry isn't about the number of participants, it's about aggregate force. 10 powerful buyers can create more demand than 1,000 weak sellers. This is why large capital can move markets. The formula is simple: price change is proportional to the imbalance between demand and supply. In practice, we observe this imbalance through price action and volume. A sharp price rise on high volume indicates strong demand. A slow bleed on low volume suggests weak supply but also weak demand. Understanding this law helps you read the market's true direction. The second law is cause and effect. In Wyckoff, the accumulation or distribution phase is the cause, and the resulting trend is the effect. The longer the cause, the larger the effect. A short accumulation leads to a short trend, a long accumulation leads to a long trend. This is often quantified using the count concept. The width of the accumulation range gives a target for the subsequent move. The formula is projected move equals width of accumulation range. For example, if a stock accumulates between 50 and 60 for several weeks, the price target after breakout is roughly 60 plus open parenthesis 60 minus 50 close parenthesis is equal to 70. This is a rule of thumb, not a guarantee, but it provides a framework for setting profit targets. The third law is effort versus result. Volume is the effort, price movement is the result. When volume is high but price moves little, it indicates absorption. Smart money is soaking up orders. When volume is low but price moves a lot, it signals a lack of interest, making the move suspect. The formula is efficiency equals price change / volume. High efficiency, big price move on low volume, is often a warning of a weak move. Low efficiency, little price change on high volume, suggests accumulation or distribution. In practice, you compare the relationship. If volume spikes but price stalls, expect a reversal. If volume shrinks on a pullback, the trend is likely healthy. Wyckoff outlines 7 logical events that form a complete reversal structure. They appear in sequence, like acts in a play. First, the climax, a high-volume spike at the end of a trend, signaling the start of a reversal. Second, the reaction, the initial counter-move, confirming a shift from trend to range. Third, the secondary test, price returns to the climax level but on lower volume, showing that selling or buying pressure is waning. Fourth, the false breakout, a spring in accumulation or an upthrust in distribution, this is the most critical signal. Fifth, the true breakout, price leaves the range with expanding volume. Sixth, the confirmation, a pullback after the breakout that holds, with shrinking volume. Seventh, the trend unfolds. These events don't always appear perfectly, but understanding their logic helps you time entries. Now, let's map the 7 events onto the 2 main structures, accumulation and distribution. In accumulation, you first see preliminary support, a bar with a long lower shadow, indicating buying. Then, a selling climax, a massive volume bar as price plunges, often retail panic. An automatic rally follows, forming the range's upper boundary. The secondary test brings price back near the low, but on shrinking volume, showing exhausted selling. The spring is the false breakdown, price pierces support, trapping short sellers, then quickly reverses. A sign of strength is a high volume up bar breaking the range. After a pullback on low volume, you find the last support point, an ideal entry. Distribution is the exact opposite, replace support with resistance, selling climax with buying climax, and spring with upthrust. Let's look at a real-world example, a distribution structure on the Euro to US dollar 3-minute chart. The first signal is a preliminary supply, a bar with a long upper shadow, hinting that informed traders are absorbing demand. The uptrend then loses momentum, price makes a new high but on lower volume, a classic effort versus result divergence. An automatic decline brings price back to the range's lower boundary. Then comes the upthrust, a low volume, wide range up bar that breaks the range high. Retail traders see a breakout and buy, but smart money uses this liquidity to sell. Price reverses sharply, and volume expands as it breaks below support. If you can spot this upthrust, you avoid buying the top. Now, an accumulation example on the pound sterling to US dollar 1-hour chart. On the left, preliminary support appears, a bar with a long lower shadow and above average volume, indicating institutional buying. Then, a selling climax, a very wide bearish bar with a volume spike, as retail traders panic. An automatic rally forms the range top. A series of secondary tests follows, each retest of the low shows shrinking volume. The spring appears, price breaks below the previous low, triggering short stops, but volume is huge and price closes with a long lower shadow, then rallies. This is the classic false breakdown that completes accumulation. Finally, price breaks above the range with expanding volume, confirming the markup phase. The highest reward to risk entry in Wyckoff is after a false breakout. In an accumulation scenario, you first see a spring, a low volume, wide range bar that breaks support. That's the first warning. Then, the next bar immediately reverses, closing back above support, the second warning. Price then pulls back to the support level, and if volume shrinks, selling pressure is exhausted. Finally, a high volume up bar signals the entry. Your stop loss goes just below the spring's low. For profit, hold until you see a preliminary signal at the trend's end, such as a high volume climax. In distribution, reverse the logic. This strategy lets you enter right as smart money has finished absorbing, with a small stop and large profit potential. The Wyckoff method isn't about predicting price, it's about understanding the game. You now know the 4 phases, the 3 laws, and the 7 events. Springs and upthrusts are your highest quality signals, they reveal smart money's true direction. Always prioritize risk, place stops at the extreme of the false breakout. This method requires practice, you won't master it overnight. Trading is a probability game, not a certainty. Your job isn't to forecast every tick, but to trade when the odds are in your favor and to cut losses quickly. Remember, risk first, then reward. We'll keep dissecting strategies into data, mechanics, and execution. Thanks for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.